The fair value gap is one of the most effective trading concepts, and it's a strategy that has brought me numerous profitable trades over the years. However, many traders struggle with it, often using it incorrectly, which leads to losses. The challenge with trading fair value gap is identifying which gaps are most likely to work, as not all fair value gaps have the same potential. Some are far more likely to yield profitable outcomes than others. In this video, I'll share my secret hacks to help you identify the fair value gaps with the highest probability of success, along with my top trading strategies that have helped me achieve consistent profits. Let's dive in. First, what is a fair value gap? A fair value gap is a formation on a chart that involves price moving sharply towards one direction, forming a gap on the candlestick. Often, the price is drawn back to the gap like a magnet as it attempts to retest or fill the gap. Traders can then look to enter a position at the gap, aiming to profit as price tends to bounce off after retesting it. To plot a fair value gap, you first need to identify a 3-candle sequence. Then look for a large candle between 2 smaller candles, where the high of the first candle and the low of the third candle do not overlap with the middle candle. The gap between the high of the first candle and the low of the third candle is called the fair value gap. Next, you can draw a rectangle on the chart to mark the gap. This concept also applies to the bearish setups. Remember, if there's no gap between the high of the first candle and the low of the third candle, then there is no fair value gap regardless of how large the second candle is. Alright, so now you know how to spot and draw a fair value gap. However, as I mentioned earlier, not all fair value gaps are equal. Some have a much higher chance of giving you a profitable trade. So now I'm going to share 5 hacks that I use to help you identify which fair value gaps are the most profitable. Number 1, to ensure that a fair value gap has a high chance of success, it needs to remain what's called unmitigated, which means not retested. So whenever you see a fair value gap on a chart, you need to make sure that it hasn't been retested by the price yet, because it is at the retest that you can take a trade and watch price bounce off the gap immediately after retesting it. So, a fair value gap that has been retested in the past is already violated. Another important thing to note is that the price shouldn't retrace too deeply to the point where it closes below the gap. If it does, then the fair value gap is also invalidated. So the best fair value gap entry is when the price hasn't retested it before, and when it does retest for the first time, make sure it doesn't break below the gap. Number 2, whenever you spot multiple fair value gaps on one setup such as this example, always prefer the ones with large size. Larger fair value gaps such as this one almost always work better compared to smaller ones because they represent a stronger imbalance between buyers and sellers. This means they are more likely to act as stronger areas of support or resistance. Moving on to number 3, if you found a setup with multiple fair value gaps that are about the same size and none stand out to be larger, you'll need to filter them out based on their position. The ones you use are the fair value gaps located in the lower portion of the move, which usually has a higher chance of working. But to do this more precisely, you'll need a tool on a charting platform like TradingView. You can use the Gambox tool. You then go to Settings and remove all other price levels, leaving only 0, 0.5, and 1. To use the tool, you drag it from the swing low to the swing high of the movement that contains multiple fair value gaps. This line in the middle separates the fair value gaps, and you should only focus on the gaps located on the bottom area and ignore the ones on the upper area. Same thing for downtrend. Just drag the tool from the swing high to the swing low and only focus on the gaps located on the top area. Number 4, a type of setup you should absolutely avoid is when a fair value gap forms, as the price approaches a major key level. For example, let's say you spot a bullish fair value gap forming. But when you look back, you notice that there's a major resistance level above. It's best to ignore this fair value gap. This is because key levels could cause the price to be rejected and reverse from them, which may invalidate our initial fair value gap. Moving on to number 5. Fair value gaps that form near a break of structure are gold. If you manage to spot these types of fair value gaps, they have one of the highest win rates compared to other setups. When a fair value gap forms near and after a break of structure like this one, it signals a high win rate setup. In such cases, the price has a higher likelihood of retracing to this gap and bouncing from it. So now that you've learned the 5 hacks to spot high-quality fair value gaps, let me share the best entry technique for trading them. The best entry point when trading a fair value gap is to enter a trade right in the middle of the gap. To do that, we use the same Gann box tool. Drag it from the low of the fair value gap to the high of the fair value gap. So this middle point will be our entry. Next, you wait for the price to retrace to the midpoint. Once it does, you're good to enter the trade. So you open a buy position. And as for your stop loss, set it at the break of the fair value gap or the point of invalidation. You can see how price bounced off the gap and pushed up immediately. If you have any questions, pop them in the comments section, as I will do my best to give answers to them. Don't forget to like this video and also subscribe to our channel so you don't miss out on our new videos. Thanks for watching, as I hope to see you in the next video.